Good morning, everyone. I'm Taylor Combaluzier, a mining analyst at Red Cloud Securities. We welcome Stephen Roman, President and CEO of Global Atomic. Global Atomic is moving its high-grade and permitted Dasa uranium project in Niger towards feasibility. Stephen, you have 15 minutes, and then we will have a 5-minute Q&A session at the end of the presentation. And just a reminder to attendees, please feel free to ask questions using the Q&A link, and we'll get to them at the end. So go ahead.
Thank you, Taylor, and good day, everyone. Thank you for coming to the Global Atomic presentation today. I'm Stephen Roman, the founder and the president and CEO of the company. So we'll just move along these slides. That's sort of a standard disclaimer. We'll move along that. Global Atomic is a bit of a unique company in that we have two operating businesses. One is the uranium side and one is the zinc side. We did a merger between our zinc producer and our uranium company in 2017. And that model has actually worked well for us because the cash flow from the zinc has really helped us to develop our big uranium asset at Dasa. So the uranium, we have 4 deposits currently in the country in Niger, and the big discovery we made in 2010 was our Dasa project, which is our flagship. And we've raised about between $50 and $60 million as a private co to develop that asset. We've done about 160,000 meters of drilling there. We've completed 2 PEAs looking at different options on how to mine it, and we'll go through what we've chosen here today. So this is the longitudinal section of the deposit, and what we've done right now, based on cash that we've received from our Turkish operation, we were able to define this area you can see in the green box called the flank zone. So we call that our phase 1 mining area. I think what people need to understand is that area that we will start mining on is only about 18 to 20% of this deposit. So what we did is we focused on that area. Here is a grade tonnage report on varying cutoffs. So we're using about a 2,500 ppm cutoff in this initial flank zone mining area, and you can see indicated and inferred some spectacular grades and pounds available to us as we move along. So our PEA that we did in May of 2020 is showing us in this flank zone area, we will be mining for 12 years at about 5,400 ppm or over 0.5% uranium, producing about 44 million pounds of yellow cake. So that cost for that project was $203 million, with an all-in sustaining cost of $18.39. The actual OPEX was in the $16 range. So that gives us an after-tax NPV of 210 million, IRR of 26.6. But I think the important thing to mention here as well is that that's all done at $35 a pound. So our view was the market is down in that level, between 30 and 31 right now. $35 a pound seemed to be a reasonable place to do a base case model, but we have done sensitivities, and you can see those sensitivities here. So running down to $25 a pound or up to $50 a pound, and how that affects the NPVs and IRRs. So most people seem to be using between $50 and $60 a pound as an incentive price. So that would give us close to a 500 million after-tax NPV and 46.3% IRR. So this is a very robust project. We decided to start it as a 4 to 5 million pound a year operation. It is totally scalable. So we felt that, a new company, a new entrant in the market could sell 4 to 5 million pounds a year. But clearly, if the market improves, so we can scale this up. This is our estimated production from 2024 when we begin commercial operations and producing, just over 4 million for a number of years, and then up to 5 million pounds. And what we've done is we've shaded the balance of this chart to show that we would run right from phase 1 into phase 2. If you remember on that longitudinal chart or that longitudinal drawing, there was a number of other workings on there. That's from previous studies that we've done, and what we're doing right now is we've announced a 15,000 meter drill program starting in September. That's going to move a lot of the inferred to indicated and measured so that we will be able to wrap a feasibility and an NPV around phase 2. So wait for that to come out. Milestones we've achieved over the years. So I've been in Niger with our team since 2005. We actually signed our agreements with the government in 2007 on 6 permits. As I say, we have 4 deposits. And, we raised funding with big players like JP Morgan, Macquarie, Investec when we made that DASA discovery. So it was something that looked extraordinary, Athabasca style. We found it with a blowout on surface. It was running 30%. So we said, we haven't seen anything like this in Africa and not in Niger either. So we decided, okay, this is the place that we need to focus our efforts. And so that's why we've done that much work on this project. And we are now in our final feasibility stage, doing the final engineering. And the idea is to start moving dirt in Q1 next year, 2022. So you'll see here 21, 22, we will be moving forward with our ramping. So this is an underground ramp access. It's exactly the same as what Cominac was doing just 100 kilometers north of us. So as someone mentioned earlier today, the Cominac mine shut down at the end of March. So we have an in situ labor force looking for the next project. The government, of course, are very keenly behind this project, and they wanted to move forward as quickly as possible to provide jobs and, of course, revenue for the country, since Cominac is now offline. Niger is the 5th largest producer in the world. I focused on Niger with our initial exploration because we just find the permitting regime there much, much quicker, much easier. You don't have issues with First Nations there. So, my background was with Denison Mines, and I worked in the Athabasca for years. And I felt, what, let's go to Niger. There's elephant deposits available there. The government was just opening the country for new investment in 2005. And so we were one of the first ones in the door and tying up some excellent ground. So since we've been in the country, we've also done a lot on the ESG front. That's paramount for this company. So we've participated in bringing in food during periods of drought. We're drilling currently water wells for small villages and towns. We're instituting some new agricultural programs. So these are all part of the mandate that we have as a company to improve the lives of the local people in the area. So, it is a poor country, and the people are very enthusiastic about mining, and they really like the fact that a foreign company has come in here and is actually developing assets that can benefit all of them. So we are big on that front. So as we mentioned, we have also a zinc business. So we'll just go on that briefly. And this is a shot of our project. We've been operating profitably in Turkey since 2009. And we started an operation there during the height of the financial crisis by acquiring an old shutdown operation. And in 2019, we knocked it all down and built a completely new project. It was a $26 million project. We'll have payout on that. It was completed in 2019, excuse me, and it will be paid out this year. So I'm not going to go through all of these numbers because of shortage of time, but needless to say, starting in 2022, dividends will start flowing again to the parent co. And we do get management fees and sales commissions every month. We brought in a big group called the Feza Zinc. They're the biggest in the world, fantastic operator. We have a great relation with them. And they basically earned into our project, and we use their state-of-the-art technology in our new plant. So this is a very clean, very efficient operation. We get better zinc recoveries at much lower cost. Little snapshot here of our share structure. So we have about 160 million shares outstanding, close to a $500 million market cap. Canadian dollars. Markets, of course, this week have been a little bit shaky, but we're moving ahead with a fully permitted project. And of course, as I mentioned, we'll be starting to move dirt in Q1 next year. Now, because we have an in situ labor force with our management team, we are able to move this ahead as an owner operated mine. So we've actually started acquiring some equipment to move to site here in the next month or so. Our camp has been expanded and it's now going to be double in size to handle increased people coming to the site. And of course, in September, we start the big drill program that'll help us move into a phase 2 and show the street the numbers on that particular part of the deposit. Lots of experienced people on board here, both from Denison Mines, from Areva, Orano, from various other operations around the world that have either been working with me over the years or we brought on in recent time. So I think, we don't need to go into the uranium market currently. I think that's been discussed enough. I think this is an interesting slide that was prepared by Cormark Securities, and excuse me, how we rank in dollars per pound with our peers. And I know there was one earlier slide that showed us at about $2. I think with our zinc business worth about 200 million. Based on where Befesa trades and the multiple to EBITDA, that accounts for about half of our market cap. So the uranium price, we feel right now it's only being credited with less than $2 a pound in the ground for a fully permitted project moving into production. We think there's a lot of upside here, and we expect to be one of the first new producers to come on stream. Cost-wise, you can see as we stack up there, the $30 mark, that line, that gold line going across, that's where we sit right now. And we are the third bar from the left going to the right. And, we're below $20 a pound, all of our costs in. And we feel that with this feasibility coming on, we're going to be able to improve both the CapEx and the OpEx just from optimizing the operation. We've run a pilot plant with ore from the mine, representing the first 5 years of production. And we've been using less acid, much quicker leach times, etc. So this is really going to transfer into being one of the top uranium producers in the world. So that's our investment case. We're fully permitted. We have cash flow coming in from our zinc operation, which will be paid out this year. Tight share structure, a strong shareholder registry, including many institutions, and myself, of course, as the founder of the company. I'm a big shareholder. Put my own money on the table, and we've been developing this along the way. And of course, being a nuclear proponent, we are definitely on the path to net carbon zero using nuclear power, and we're very excited to be part of that business. Thank you very much.
Great. Thanks a lot, Stephen, for that presentation. I just remind everybody that you can submit your questions using the Q&A button. We do have a couple that have come in already. The first one I'll start off with is the company exposed to significant Forex risk by operating in Turkey?
No, we are not, because we produce our zinc concentrate and we sell it in Europe. So it's sold in US dollars and our revenue is in US dollars. So what we do is we repatriate enough capital for working capital to, pay people, et cetera, in Turkey. Those dollars are translated into the Turkish lira. So actually, costs have been going down from that point of view because of the devaluation of the lira. But we are paid and operate all in US dollars.
Great. Okay. Another question up is just wondering on the existing CapEx for DASA. You mentioned that you're going to be doing some work to help improve that. So maybe just provide a bit more detail on that and where it stands today.
Okay, so the PEA was showing 203 million. What we feel that we may be able to do is get the mine started and actual start ore shipments to Orano. We do have an MOU with Orano that I didn't mention. We signed that in 2017. They would like to extend the life of their Somer operation by potentially augmenting it with feed from DASA. So that could reduce our startup capital, give us cash flow then from both Turkey and a uranium at DASA. And then with that, come up with a much more favorable financing to actually build the plant. So we'll have the numbers out end of Q3 on the overall, but then we do have options on how we start this project.
Great. Okay. Next question. What are the primary reasons for your low cost? Are they structural or related to scale and jurisdiction?
I would say the low cost nature is because the deposit comes right to surface. We can do a very efficient mining using a ramp, and the grade is much higher than anywhere else in Africa. So we are using an average grade on this phase one of over 0.5%, but there's many areas in that whole flank area that are running at over 1%. So it's just amazing, this project, from a point of view of grade, and also that it's a very clean ore. There's no deleterious elements. It leaches very well. So we're getting 94% recovery using acid leach. Keeps the cost very low. We don't have to mine a lot of tons. So we're 1,000 ton a day operation, producing 4.5 million pounds a year.
Okay. Number of questions. Have you received any indication yet from the Nigerian government for what percentage they will take of the Nigerian mining corporation that needs to be created?
Yes, I understand the question. So typical of West Africa, the governments typically have a 10% carried interest in the shares of the newly formed mining company. So the government in Niger has an option, if they fund their pro rata, to buy up to 40%. Typically, they don't do that. We've submitted a letter to the new mines minister asking for a clarity on how much they would like to have. And of course, if they decide to go above 10%, they have to pay for that piece. So that would again be reflective in how much money we would have to raise. We have not heard back from them yet, so we're expecting to hear back from them soon.
Right. Okay. At what point are you going to pull the trigger to start construction? You say the AISC is $19, which means you're profitable at the current rates of uranium, your current prices.
Yes, Q1 2022 is when we start moving dirt. So we'll be doing the box cut for the portal, and then collaring the portal and starting the underground development.
Okay, and then very quickly, is there a portion of production that would be reserved to take advantage of much higher uranium prices?
Oh, absolutely. Yeah, so right now, we have not contracted any of our uranium, although we do have a marketing arm. Effectively, we signed a deal with a company called Fuel Link, and they're very well known in the uranium space. So we are speaking to utilities right now. We're having meetings with them, and so we we expect that we will have some offtake agreements, and we're speaking to people internationally on that front.
Perfect. And with that, we are out of time. So thank you very much, Stephen, for presenting Global Atomic to us. And
My pleasure.
up next, we have Pure Point Uranium.
Thank you very much.